may not have just saw us walk in. We were taking a nap in the living room.
You get really nervous about this stuff.
I don't get nervous at all. You're the one that was sweating profusely last time.
But I feel much better today, Dave.
Well, here, first, let's adjust these microphones so we're not like...
I don't think people care about what our microphones look like as long as we sound okay.
No, yeah, but I don't want to be like crinking my neck.
Well, good morning, everybody. Welcome to episode 2 of Java with Josh.
The summer solstice edition.
The longest day of the year. My wife loves the first day of summer. She wakes everyone up with a happy first day of summer, and then I remind everyone that from this point forward, the days get shorter and it gets depressing. So,
or in my house, what I say is one day closer to fall.
You could have Alex as a kid because he wants winter back so he can be cold again.
But, perfect.
So last weekend was Father's Day weekend. It's the one weekend a year that everything revolves around you and I. Yeah.
Happy first Father's Day, Brian.
Oh, yeah, it was Brian's first Father's Day.
Didn't even think about that.
Man.
Oh, that's awesome. Cool.
And I had a first with my children that I was super, super excited about.
Okay.
All right. Missy surprised me. Mm-hmm. And she kind of set up the afternoon as a entertainment for me with the kids.
Sure.
And we finished the afternoon at my all-time favorite restaurant. Do you know what that is?
Arby's.
That's yours. Benihana in Wheeling.
Yeah. Oh, the Wheeling location.
The Wheeling location. Now, Missy and I, we had a condo up there when we were first married, and the Benihana was in our parking lot.
Right.
And that Benihana far surpasses any other I've ever eaten at.
Same chefs?
Same table thing, but it's different sauces. I don't know what they do, but we took the kids for their very first Benihana experience because I have picky eaters.
Yep.
They loved it, and in fact, Zach told me that's where he wants to go for his birthday dinner. So I'm happy.
Mission accomplished in life.
So, well, everyone tuned in for some updates on our summer solstice edition. I don't think they really care about my Benihana experience, but I do care about what you're wearing because as I was preparing for this, I was watching last month's episode, and I consciously picked out a different shirt and tie.
Yeah.
And I want to know if you consciously or subconsciously wore the exact same shirt.
Look, it comes down to this. I have 3 work shirts. The other 2 were dirty, so I was left with my red flamingo shirt. I'm wearing different pants and different shoes than I did last time, Brian, so you'd be proud of me. Brian's like the fashion king here at the office.
He is.
Yeah, he's awesome.
Don't tell it to anybody else.
But, okay.
All right. Before we get going, a little bit of compliance here. So anything that we go through today is for informational purposes only. I am happy to give any advice to anyone that is listening, but you got to come in or call us one-on-one to make sure we figure out how it applies specifically to your situation. So.
Oh, and Josh, look, we got a first comment from a Carla Janira. These are facts, Joshua. We think she's referring to
your clothes.
Yeah, probably.
Because she is your wife, and she probably picks out your clothes.
Hi, Carla.
So, again, more facts.
That's so sweet. Thank you for submitting that comment. And then, so Josh, we want to talk a little bit, just a quick reminder about what Java with Josh is, correct?
That's what I was hoping for.
Sure. So Java with Josh is a monthly live show where it is going to be half a timely market update from this guy right here, Josh Bretl. The second half of our show will be Q&A, live Q&A from people leaving comments on Facebook and YouTube, or we had a handful of people pre-submit some questions. And ultimately, the goal is to have fun. And like I said last time, people want more Josh. So we will give you the date of our episode 3. We already have that figured out. We are planners here.
We are planners.
Big-time planners. And
not planning enough to get the different shirt, but we're planners.
No. Carla, buy me some new clothes.
So, well, thank you. No, this is exciting. I'm glad we're on to month 2.
Oh,
so,
did you know what today is?
The first day of summer.
Yes, but episode 40 of our podcast just went live at 4 a.m.
Oh, 40. Episode 40.
That's an accomplishment, man.
I mean, we're a year and a half into. That's great. If you aren't checking out the Retirement Equals Freedom podcast, I highly suggest you do. You get more of Dave and I, which is everyone's dream. Mm-hmm. So, Dave, before we get going, I wanted to make an announcement. If anyone is watching this week, we are sponsoring something that a good friend of mine, Tracy, has kind of spearheaded here in Chicagoland. This is an Aruna. Aruna is a charity that helps Indian women get out of the brothels over in India and provides work for them and stuff like that. And I give my friend Tracy a lot of credit. She kind of picked up the reins on this and ran with it, and I wanted to help her any way I can. So if you're around this Saturday morning at 8 o'clock in Elmhurst is the Aruna 5K. Myself, my family, a lot of our office will be there, and we hope to see you there. So that is my last announcement before we get into this.
I'm excited.
All right, so this week, Dave,
Yeah.
we're going to talk a lot about interest rates. We're going to talk, and I talked a little bit about this last month, but I'm going to address it in a different fashion, in a different way today, kind of from the investor's viewpoint. So let's get into this here. And last Wednesday, the Federal Reserve paused their interest rate raises.
What's with the air quotes?
It was, well, you'll hear that in a second what the air quotes are for, but the Federal Reserve has raised interest rates starting last March at 10 straight meetings. And they were determined to do this to combat inflation. And what they said was they wanted to target a certain inflation level. The stock market has not liked this. They, in fact, have been clamoring for an interest rate pause or even a reduction since the beginning of the year. And Chairman Powell has pretty much been saying, no, we're gonna combat inflation. And he kept going and kept going. So for 10 straight meetings, they raised interest rates, stopping for the first time last Wednesday. So you saw all sorts of headlines. Every different financial website had a different headline. It's kind of what we're looking at here. And, you know, Chairman Powell had some cover here. So he had CPI, Consumer Price Index, which is a measure of inflation, but you knew that, right, Dave?
Yeah, I wrote it in the notes.
You did? Oh, thank you.
Yeah, sure.
Actually is less than half of what it was from its high last June. So he had some cover here, but there was a lot of people that were actually expecting rate decreases later in the year. And in order to temper that, what he actually said is this is not a stoppage of raising of rates, but he called it a pause, and they may continue later in the year. So the air quotes right there was for that. We don't know what the Fed's going to do. We have no idea. But I wanted to give you a little history of that. So as we go on here, this is our interest rate raises from last year. So what you're going to see is we started last March with a 25 basis point raise. Then went to 50, and we had 3.3 75 basis point raises. So 75 basis points is 0.75%, and that is a big raise. To see 3 in a row is huge. They dropped it back to 50, and then the last 3 have been at 25, and that took us to April of 2023. Now, that left our rate around 5 to 5.25%. This is a huge jump. It's the quickest jump we've ever seen in history, and this has some impact on all sorts of different things. So why I said earlier the market was clamoring for a reduction and the market doesn't like this, why doesn't the stock market like this? And it has to do with what you can do with the money. So there's 2 reasons off the top of my head. One is a lot of companies, a lot of publicly traded companies, which is our stock market, they'll hold debt. They'll hold loans, and a lot of those loans are interest rate sensitive. So as interest rates rises, the cost of that debt goes up, and the expenses get higher. So if expenses go higher, profits go down, and when profits go down, the stock market doesn't like that. So that was reason number 1. Reason number 2 is this is kind of what will trigger our treasury rates, and treasury is a risk-free investment. Again, air quotes there, Dave.
Sure.
Risk-free is kind of the comparative investment. So if treasury rates are paying 5, if you're going to take risk in the stock market, you expect it to earn quite a bit more than the risk-free rate. So as that increases, that drops, it makes it more attractive, which makes stocks less attractive. So that's why the market was kind of clamoring for that pause and that stop as that come into play. Make sense?
Makes total sense. I knew like the way you speak, you're gonna ask me if it makes sense, and I'm prepared to say, yeah, total sense.
I ask, does it make sense a lot, and I blame Chuck Carey for that in my office. So Chuck's another advisor, and he once told me, Josh, I like how you ask people if it makes sense. And ever since then, I just do it over and over again. So I apologize if it drives anybody nuts.
Chuck, C squared is my boy.
So let's get...
Gotta give him a shout out, Brian.
But I want to show you why these things change all the time. And this is I'm graph heavy again. I love graphs. I apologize for anyone that hates graphs. But this graph shows how fast market expectations change. In fact, if you look here, this is the two biggest changes there. The silver bar, the one on the far left here, these were market expectations. So when I say market expectations, these are the Fed funds pricing, things along those lines, of what they expected throughout the rest of the year on March 8th of this year. So what they expect, if you'll see here, in June, they expected to be at 5.6, July 5.7, December 5.6. That was where the market was, quote unquote, trading at. Well, then about a week later, we have some big bank collapses. We have SVB Bank, we have Signature Bank collapses, and the Fed realizes, oh man, we're causing a lot of problems here that, maybe inflation isn't the worst problem. And look at what they said here. I mean, this would have factored in a rate decrease in that time period. And they were actually predicting some much lower rates by the end of the year. And that was just a week later. So as we go forward here, there's some things we want to make sure we're considerate of because, our end of May predictions brought us back to right around where our terminal rate is. So we'll see what happens here. We'll see where this goes. But this has some serious impact for what's going to happen in the market and what's going to happen to different banks. So,
tell our fans we did a podcast episode on the bank closures recently.
We did, and if you haven't heard it, it's probably one of the better podcasts that we did. Not that they're all not wonderful, but that was a good one. So we can somehow link to it in the comments. Maybe?
Yeah, I'll link it to it in the comments.
Sure,
I can do that.
That's great.
Yeah.
Beautiful. So, moving forward, I want to show you something that's changed this year. Sorry, Dave, as I just cut forward here. We promised everyone half an hour, and I realize I've been talking for a long time already.
Oh, you're good.
This is our yield curve. Now, retirees, especially over the last decade to 15 years, they've gotten really used to low interest rates. And when you put money in the bank and you earn zero, that was pretty normal for you. You didn't expect much of it. And it's changed a little bit. So this is our yield curve. So what I want to show you here, this is the yield curve in February of 2022. And I want you to notice its shape. This is important. It's lower here on the short term. So our 3-month rate was 0.31, and it goes higher. So the farther out you go, the higher the interest rates are. And this is normal because the longer out you go, the more risk that the lender holds. So they raise interest rates for that risk. That's a normal yield curve. And quite often what you'll see is yield curves can go up or they can go down. But what we're seeing right now is something kind of crazy where the shape has changed, and it's now an inverted yield curve. This is the yield curve as of May 31st, where the short-term rates are significantly higher than the long-term rates. And what this has done is this has said to people who have been used to earning zero on their investments or on their savings, their money markets forever, to expect, hey, now I can get 3, 4, 5% from the bank, and they think this is going to carry on forever. And this is kind of not a normal thing that's out there. So one of the big questions we get right now is, should I just be in cash? Should I be in treasury? Should I be here? And I want to show you why we always say a good diversification and good solid policy is always better than rushing one way or the other. So I kind of want to get into that next.
Sounds good. Can I give you a little tip?
Yeah, I love tips.
Look at the cameras when you're talking.
Oh, the cameras?
Yeah, not the computers. Yeah, your eyes are down here.
You'd figure in a world of Zoom I would learn that.
I think you would. Yeah, that's all right. I'm here. So I get paid the big bucks, folks.
Oh, man. Well,
back to the iPad?
Let's go back to the iPad. I want to show a long-term and a short-term thing here. So I showed this graph last time, I think, but I want to go through it a little bit and show you why it matters in the long term. As cash builds up, cash can be a part of your plan, but thinking that hey, cash is paying 5%, so we're going to earn 5% forever, is not really what you want to do, because the reason it's paying a lot right now is because of the Federal Reserve kind of try and counteract inflation. So I want to show you a few things here. This orange line that you see here, that's right in the middle, that's the CPI inflation. So I talked about the CPI earlier. What you see down here, let me delete that so it's easier to see. But what you see below that is something called real cash returns and nominal cash returns. So nominal cash returns is what you actually earn. So if you earn 4% here, that's nominal. That's a 4% earnings. Real is when you compare it to inflation. So if you actually earned 4%, but inflation is 8%, then it's actually a loss of money as that comes into play. So, we having technical issues? Or are we good?
No, we're good to go.
All right,
good to
good.
go. Yeah. I think Brian just says your eyes are beautiful, so we want to see them more. Is
that what it was?
I'm pretty sure, yeah.
You really want me to look at the camera. It drove him nuts last month, and it's driving
That's
him
right.
even crazier this month.
Can I just, a little PSA here, for your clients that are watching, they know our personalities. If you don't know us well, we have a lot of fun here. We take what we do dead serious, but we're not afraid to
have some fun.
To be silly and be fun, so.
Well, we want to look good, too. No one wants to be embarrassed, and if I'm staring down the whole time, I understand that.
Right.
So, but back to my chart, Dave. Back to my chart.
Yeah, sure.
So what I'm worried about, though, is if you're sitting in this large cash for a long time, you're actually losing money. And I have a friend, another advisor, who says this is the safest way to lose money because the market won't take it, but you're still not combating inflation. So we do want to make sure we're thinking about it from a big perspective. And here's why. Here's the next one. All right, this is why right here. So this graphic, ignore the left, but what you're seeing over here on the right, these are the last 3 giant cash influxes. So when money market accounts reach their peaks, oh, you're moving me across the screen. Look at that. This is the last times that money markets, when they've reached their peaks. So let's think about this. Why do money markets reach their peaks? They reach their peaks because people are rushing into cash. And why do they rush into cash? They rush into cash because either interest rates are high or because they think the market's going to collapse. So when people rush into cash, I want to show you what the market performance was the last 3 times that has happened. The U.S. stocks in 03 to 06, and this is a 3-year time period, went up 16.4%. In 09 to 012, they went up 19%. And just in 2020, if you remember March in 2020, we had a massive rush to money market accounts. The market's up 13.1%. So here's what we'll kind of preach here, that this is, yes, cash plays a part in every part of diversification. It's still a tool that you want to utilize, but it's a tool, and we never want to make knee-jerk reactions one way or the other. Having a good, solid plan, good, solid diversification is really the key that comes to it. So as we're comparing things, make sure we're not getting caught in that short-term mindset and that short-term thought process, because as my friend Ben from AE Wealth says, one of the risks that people don't think about is reinvestment risk. Someday that CD that you just got 5% on is going to come due. Then what are you going to do with the money? And if rates are way low and the market's way high, you have nowhere else to go with it. So you have to make sure you think to the big picture. So did that make sense, Dave?
Yeah, duh. I mean, I gave you the lesson on what to talk about today, so of course it makes sense. I mean, this is my topic.
It is your topic.
Yeah.
So, all right, one more slide, and then I'm done with slides.
Sure.
All right. This is, you don't have to move me. I'll move the slide if you want.
Okay.
But this is the periodic table of investments, is what we call it. Yep. Not only do I love graphs, I loved chemistry in high school, and the periodic table was fun because it made sense. But what you're seeing here is these are different. Asset classes. So what you'll see here, let's look at commodities is a great example here. Commodities is this red color here. And in 2008, it was right middle of the pack, and then it went down to lower the pack. Then it was top of the pack, and then we had a couple of low years where it was the absolute worst thing to be in. And then we went up, and we went back down, and then we went back up, and you get the picture. Last year, it was the best thing you could possibly be in on this graph. And they all move all over the place, and people will rush to what's hot right now. They rush to say, okay, commodities are great. I'm going to be in commodities. Dividend-paying stocks, I'm going to be in dividend-paying stocks. Foreign things, I'm going to be in foreign assets. But we're, the great Wayne Gretzky quote, always skate to where the puck is going. What happens here is what you're going to see is that good diversified portfolio, Dave, if you'll go back to my little graph here, is that line in the middle. It's always right in the middle. It's never the best. It's never the worst. It's right in the middle. And that's where you want to be. You want to have a well-diversified, well-built, go through the fundamentals portfolio where this is taken into consideration. And normally we'll say, over the last 10 years, we've been talking about that with stocks, telling people, hey, you've got too much risk. You've got too much going on. Now we're even talking about the opposite. Hey, you've got too much cash. You're taking too much cash risk, and that is an equal and opposite problem that's out there. So,
like your chart, I'm a diversified individual. Would you not agree?
You are well, except when it comes to shirts.
Ooh, roasted, as my son would say.
Your son loves you.
He does. Oh, wait, that's a different coffee cup. You savage. You have 2 cups of coffee?
Well, I did. Michael went and got us coffee beforehand because this is Java with Josh, and we needed to have coffee. And it was too big of a cup to fit in my mug that Jane made me. Jane is a wonderful client who makes mugs for our office. In fact, if you ever come in here and you drink out of our water glasses or our pitchers, those are handmade by Jane. And she made me a Christmas present a few years ago that I use all the time.
Handmade by Jane. Josh, are we ready to move on to some Q&A, my friend?
Yeah, we've had some Q&A come in. That's kind of fun.
Yes. So if you're watching live right now, which looks like we're up to 15,000 some people viewing live, it's not bad.
Oh, we're going to break YouTube.
Yeah, we've broken it before. Go ahead and feel free now. It would be the time to post in your comments on YouTube or Facebook. I believe if you're on Facebook, you do have to grant permission before you leave a comment. You're totally safe in doing so. All right, so question.
You've just granted them permission?
Well, no, they have to grant permission to our software to display their comment, whatever. Okay, question 1 comes from Jim, who I met at one of our Ditka's workshops.
Okay, so okay.
Short and sweet, to the point. What to stay away from? And I'll let you interpret that.
Okay. Is there a second part to this?
Best use of cash in the near future. So I'm assuming he's referring to different vehicles.
Okay. I'm going to take this as a 2-part question, which I guess it was. What to stay away from, and I think it goes back to the question I just talked about, was knee-jerk reactions. We're not trying to chase something that just was good. We want to make sure that we're going to where we think things are going to be. Now, your question about cash, I think when I originally read this, because I saw this question beforehand, I cheated, was... I thought it was about cash, like what I was just talking about, where you wanted to have more cash. But as I think about it more, what is it for short-term cash? And that's a great question because cash has a purpose. And if you have a short-term need for cash, you are in a great spot. There are some great ways to utilize for cash right now. So it depends on how short-term it is, when you're going to need it, and FDIC limits and all that fun stuff come into play. But that is a great question. But again, you want to make sure it's for a specific purpose. And, when you say short-term, how short-term are we talking about? So, but I'd be happy to go into that in more depth and detail.
So nice of you, Josh.
Yeah, thanks.
Thank you for that. Question 2 comes from, Tom. Is it our buddy Major Tom? Probably not.
No, this is not Major Tom.
This is not Major Tom. Okay.
No.
So Tom asks, if I am still working.
Still working.
Yep. Is it possibly cheaper to get, he used the word Medicare.
It's your least favorite subject.
All right, that threw me for a loop. Let me start over. If I am still working, is it possibly cheaper to get Medicare versus my employment medical insurance? Go.
So the question is, you're still working, so you still have access to your employee coverage, but maybe you can get Medicare. So Medicare is available for anyone 65 and over. And so if you're 65 or over, you do have the ability to get Medicare, but you're not required to if you have employee coverage. Now, that is a cost thing. So it is possible that Medicare is cheaper if your employer has, it's an expensive plan. It is something worth discussing. We are far from Medicare experts. I do have someone that, Tom, I'd be happy to introduce you to that can run those numbers for you. But it's a cost comparison, and you do want to make sure that that you take that into consideration. So
cool. Hey, we had a question posted live just now on Facebook.
Ooh, I love it.
Yeah, so not just my wife, who doesn't listen to our podcast, but apparently watches our live show.
Well,
so
she
that's
wants
cool.
to see if we're going to embarrass ourselves.
Well, she probably already turned it off. So this comes from Joseph, and he asks, oh, this is deep. Oh, I need my readers. Will you come to Naples during the winter to do Java with Josh?
I know Joe well and his wife Kathy. I think you should go back to both of us here. Don't let me just take this one.
Sure.
They recently bought a winter place in Naples, and it is about 10 minutes from my sister-in-law's place.
Okay.
I think that would be a great idea. Are you open to a remote Java with Josh?
Hey, all expenses paid, first class, baby.
Hey, I didn't
Joe,
say
thank
first
you.
class.
Oh, I'll take you up on it, Joe. Let's do it.
We'd have a lot of fun with them down there.
I think we absolutely should do it.
So.
Thanks, Joe, for doing that. I appreciate it. Last question from Nicole, and she asks, I'm worried I'm taking too much risk now that I'm nearing retirement. What the heck should I do?
Common question and common thought process. And boy, I feel like we've done a whole seminar on this. But first off, I'm glad you actually thought about this. And what I always tell people is if you think you're taking too much risk, now is the time to act, never later. Because what we're trying to do is avoid knee-jerk reactions. So, Nicole, if you think you're taking too much risk, we need to talk because there's ways to evaluate that. And what we worry about is emotions getting the best of us. So we don't want your emotions to come into play and make financial decisions because that's when we get hurt. But we can't rule them out, and we have to understand that they're very real. So we want to make sure that if you think you're taking too much risk, the best time to do something about that is before it gets us into trouble. So,
well said, Josh.
Yeah, I hope that helps. I'm not trying to avoid a question there, but
no,
that's a good one.
It's a good one. Ooh, catch your breath, son. That was a lot of talking you just did.
And now apparently I'm going to Naples in Florida in winter here. So
start booking those flights, baby. Wow, that was an awesome Java with Josh. Brian, what were you thinking for our next one? You said July 18th, you'll be good to go? We need Brian here. He's our tech support.
We do. Do you think the next one I'll learn to look at the camera?
I hope so.
I don't know what to do with my eyes. Like, do I look at you? Do I look at the camera?
I think you're focused. You're worried that your microphone is not loud enough. I think that's what you're watching. I got that, man. Just look at the cameras. All right. You're totally fine. So July 18th, I'm not sure. I think it's a Tuesday. We always get these days mixed up. I will send out an email 1 week before, and then 1 day before, and 1 hour before. I'll make sure the subject line is correct with the day and time. But everyone watching, feel free. You can always pre-submit questions ahead of time. We have a form on our website. I'll leave all the details kind of below the videos on Facebook and YouTube. I'll also be sending out a replay of this video when it becomes available, probably tomorrow-ish. And I'll leave that information on the YouTube channel as well. So, Josh, how about some closing thoughts here?
Boy, I should have thought that through. No, actually, this was a fun one. I put this together on Monday I knew almost exactly what we were going to talk about after last week's interest rate and the questions we're getting with cash right now. So it's the same thing. Make smart decisions. Don't make knee-jerk reactions and have a plan in place. So it doesn't change. I feel like a broken record as we talk about that, but I think it's an interesting juxtaposition to what we've seen over the last few years with people taking too much risk. Now they're taking not enough. So,
anything to say to Cowboy Mike in Colorado?
Cowboy Mike in Colorado, I'm sorry you didn't come in and see us here when you were in town, but I'll blame your son Dave for that.
It's always easier that way. Perfect. So, Josh, I think we're going to wrap this up, man. Another successful job with Josh, buddy.
2 down.
2 down. You're buying me lunch today. So, with that, want to do it? Bye.